everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us. As the market's volatility continues, many investors are wondering, first, what really is the cause of it all? And second, are there actual investment opportunities out there in this environment? So joining us now to discuss this and a bunch of different topics related to the markets is Jason Draho, the head of asset allocation for the Chief Investment Office. Jason, good to see you. Volatility continues. We're seeing it in the markets every single day, whether we're up, down, but the significant moves. We're talking about equities. Year to date, we're down across the board in correction territory in the S&P 500. Meanwhile, we look at the 10-year yield, and for the most part, it is in an upward direction, minus a few times during the course of the last few months where it's dropped, but continues its run up. So we're seeing yields continue to rise, which of course impacts everything from credit card rates, mortgage rates, car loans, et cetera. What's happening out there, Jason? I think a lot of people are just confused. There's so much news. There's the Fed, there's inflation. Where's that coming from? Is it supply chain? Is it Ukraine, the war that's going on there? What's the story today?
So probably all of the above.
Okay.
But to get it more precisely, I think the framework of how we've thought about the markets this year is you have an environment where inflation is too high, you have a labor market that's still very tight. The Fed then their objective is get rid of inflation or bring inflation down. They have to slow growth, get us below trend. To do that, they're raising interest rates. They're trying to tighten financial conditions, which means basically stock prices, bond prices go down. If you have that environment where the Feds basically want asset prices to decline, it's a difficult environment for the markets. That's where we've been this year. That hasn't changed. I think that's ultimately the big overriding factor driving the markets. If we think about most recently what's happened in some of the volatility, stems went on in the UK, where you had a situation where yields on 10-year gilts exploded, went very high. The Bank of England last Wednesday had to come in and kind of intervene and say, we will sort of stabilize and buy them. So within a week, you saw yields go up 100 basis points, like 1 full percentage point, and they've retraced about 75% of that. Because those yields are rising, it caused 10-year yields to rise here in the US, over 4% last week. They're back down, already down 35, almost 40 basis points from their high. So really big moves. So I think the moves of last week, again, kind of reinforced this notion of it's just a difficult environment with the Fed. Because ultimately, when the Fed raises rates, it kind of exposes or kind of highlights where is there sort of weaknesses in the financial system. Last week's a good example with what went on in the UK. You also have situations where it doesn't help when the UK monetary policy isn't collaborating very well with fiscal policy. I think that's what the markets kind of reacted negatively to. What we also learned is that there is some breaking point for central banks. The Bank of England stepped in. On Friday, we got commentary from the Fed saying, we want to tighten rates, we want to get rid of inflation, but we're not oblivious to these kind of global stresses. So I think this is an environment that's going to persist. As long as central banks kind of move in this direction, we're going to get more volatility.
Yeah, I mean, the Fed certainly has their work cut out for them, as you're talking about. I mean, I think a lot of us are aware that the economic environment right now in the UK is pretty dire. They're really having a tough time there, and you talked about what the Bank of England is having to do to try and curb that a little bit. And of course, the Fed and other central bankers around the world really have to respond and figure out how to work in concert. And that's also having an impact on currencies, which we're going to talk about in a minute. But sticking with the yield curve, and really this goes to the next question, which is, I think you're probably getting this a lot too from our advisors, from our clients, is the word recession. By definition, we can all back, anybody who took an economics class in college knows that 2 quarters in a row of negative GDP is a recessionary event. An inverted yield curve can also indicate a recession is here or coming. So the question, and by the way, we've had both of those. Are we in a recession, Jason? What do you think is happening right now?
Right. So the yield curve had a good track record of preceding recessions anywhere from 12 to 24 months down the line. This yield curve inverted, earlier this year, like in kind of the May timeframe. So we're still relatively early in that timeframe, but it's sort of heading in that direction.
Right.
You mentioned negative GDP in the first half of this year. So that's a technical recession, but it's not sort of kind of a formal recession. That the way the National Bureau of Economic Research, they have the responsibility with some hindsight to define when a recession began and ended. They use a bunch of criteria, not just negative GDP growth. They look at, is the job market contracting? Is consumption contracting? Is income contracting? Most of those things did not happen in the first half of this year. In fact, the labor market increased 3.5 million jobs. If someone told you January 1, we're going to get 3.5 million new jobs in the first half of this year, you'd say the economy is booming.
Absolutely.
So it's a really strange situation where you have negative GDP growth, but strong job growth.
Which, by the way, and not to interrupt you, but a lot of people ask the question about 2008 and 2009. Mm-hmm. That's the biggest, probably the biggest impactful recession we all can remember in modern times. And that's the difference, right? I mean, the labor market was very different then. The housing market was very different then. It's a different type of recessionary environment?
So it's 13, 14 years later, it's a different economy than back at that time period. The labor market is different. We're coming through a pandemic, so there's a lot of dislocations that are things that are kind of normalizing. So some of what's happening is just we went from consuming a lot of goods to services. So the goods economy is slowing more rapidly than the services economy, which is holding up. We also have still a really big mismatch between the demand for labor and the supply. So because everything has already been an unusual, like the first half of this year, unusual, some measures say recession, others say booming economy. Whatever sort of plays out over the next 12 to 18 months, we may get ultimately a recession, but it may look very different than any recession we've had in the past. So I think that's where, like, when we kind of use these terms, we have to sort of say, well, what does it look like? What does it mean in this case? Because I think the past, like the 2008 example, or early 2000s, early 90s, those recessions will look different than this one, however this plays out, because just the economy is different and the circumstances heading into it is different coming out of a pandemic.
Right, exactly. And correct me if I'm wrong here, there could technically be a recession happening in Europe, for example. Meanwhile, here on the US side, not necessarily so. Just because one country or region is having a recession doesn't mean it's always going to go global, depending on the economic conditions of that area, that country, that region, for example.
That's correct. So in the U.S., in some ways, a relatively closed economy. We certainly trade with the rest of the world,
right?
But we're somewhat like an island in the middle of the two oceans. So we will be impacted by slowing activity in Europe. If it's really severe in Europe, that could certainly kind of drag us down with us. But we have we're fairly buoyant in and of itself. So I think that's kind of where we are. At the same time, you could have a situation where parts of the economy, like manufacturing, could actually feel much more negativity than other parts of the economy, like services, that could hold up better. So even within the U.S. economy, it may not feel uniform across sectors, across regions of the country as well.
Right. And then interestingly, that kind of takes us into the story of what's going on in the global currency markets. If you look at the yen, the Japanese yen, the British pound sterling, they're both significantly under pressure. And even the relationship between the euro and the US dollar, they're almost on par and parity with each other, which we have really never seen. What's happening in the currency markets? Is it all connected to what's going on with the global economy, the fears of recession, supply chain issues?
So, think of currencies are a relative measure. It's the price of goods in one country versus another. So currencies always depend, like, what's the relative strength? So, the U.S. economy is slowing. There's definitely some challenges here, but relative to what's going on, say, in Europe, it's a much stronger situation. We're not dealing with the energy supply disruptions. There's not a war right on kind of right on the borders. So on a relative basis, the U.S. looks better. The Fed can raise rates more aggressively versus other regions. Higher interest rates here attracts capital. People want to own U.S. dollars. They don't want to necessarily own euros. That drives up the U.S. dollar versus the euro. So that's kind of the overarching factor of why the dollar is stronger against almost every other currency this year. Then you add in the fact, and this goes back to an earlier point about monetary and fiscal policy at cross purposes. So if you have the situation where the Bank of England is trying to tighten policy, raise rates, but fiscal policy is loosening it, and they can't rely on the Bank of England to buy the bonds, well, someone has to come in and buy it. Well, the currency in some way has to decline to kind of draw investors in. So it's also like when people see these things where they don't think the policy is right, ultimately that's not great for the currencies. That's happening in the UK. There's an issue that could happen in Japan as well. The Eurozone to some extent. That's why the US dollar, all else equal, looks like it's a pretty safe ship in stormy waters globally.
Right. Interesting. Thank you, Jason. So let me have you bottom line it for our audience today. When you look at the CIO view of investment opportunities that are available out there now, what are you talking to clients about?
So look, big picture, we're going to get continued volatility across markets. We've been very sort of range bound, whether it's in interest rates to some extent to equities. That's likely to continue, at least for the very near term.
Right.
So as a result, it's hard to make big calls like, yes, it's the worst is over, or there's a lot more downside because you get days like today, Monday, where equities are up 3%. So it's difficult to call those. So I think you don't want to make big long-term bets. Think about it as your long-term plan, kind of adhere more closely to that. Now that said, there is some opportunities that are opening up because things have sold off so much. That's true in equities and fixed income. Just think about the yield on the 2-year treasury. It's over 2%. You can then take investment-grade corporate bonds, relatively low risk, 1 to 3 year yields on that are 5.5%. That kind of opportunity hasn't existed in basically 15 years.
Right.
So 3 years ago, it was like reach for yield, reach for yield, reach for yield, take a lot of risk. Now, actually, you don't have to really reach out there to get some decent income. So, there's some opportunities there. On equities, we've seen the pullback. Things have gotten cheaper, but it's not uniform. U.S. growth stocks are still relatively expensive versus value stocks. That's one of the reasons why we like value. If you're willing to go to Europe and not just as a tourist, there's opportunities in European equities because the valuations there are 15%, 20% below their long-term average, which always trade at a discount to the U.S.
So good opportunities there.
Good opportunities. So you might think, like, why would I want to buy UK equities right now? But the valuation, their multiple is 10. In the US, it's more like 16. And UK equities are very kind of global in nature. They have a little bit defensive attributes. So there could be definitely volatility near term, but if you can take like a 2, 3, 4 year horizon, from a valuation perspective, there's definitely opportunities kind of across the board. So I think be selective, be diversified, but don't just think, well, the worst is yet to come, and I need to sit on the sidelines, because prudent shoppers can find actually pretty good deals right now.
That's right. Sitting on the sidelines is the worst idea historically. If you look back, obviously we've talked about this many times in our conversation. So good idea. Great, Jason. Thank you so much. Lots going on out there, but always good to get a clear picture from you. Good to see you.
Great to see you.
Great. And for our audience, anything that Jason and I talked about today, we always recommend you talk to a financial advisor, depending on your own risk profile, your time that you have to be investing. So make sure to reach out to your FA, and look out for more information on our website, ubs.com/views. Plus, there's lots of content on our social media platforms like LinkedIn, Facebook, Instagram, Twitter. Plus, all of our past UBS Trending episodes like this one are available on demand on our website or on the UBS YouTube channel. Thanks for joining us, everybody. We've got more great content coming up for you in the next few days. Obviously, we're keeping an eye on the markets and all the incredible volatility that's out there. But again, we've got great partners from the Chief Investment Office like Jason to sit here and have these conversations and navigate us through. So in the meantime, have a great day, everyone. Remember to keep your eyes on what's trending. We'll see you soon.